Good afternoon, ladies and gentlemen. My name is Peter Warne and I am Chairman of Argo Global Listed Infrastructure Limited, which we refer to as Argo Infrastructure or ALI for short. On behalf of the Board of Directors, I'm pleased to welcome you to the 10th Annual General Meeting of the company, my first as Chairman, and to report on its operations and financial results for the year ended 30 June 2025. Before we begin the formalities, I would like to inform you that the meeting is being filmed and streamed live on the company's website to shareholders who are unable to be here today. A recording of the meeting will also be available on our website later in the day. Can I please request that your mobile phones are turned to silent? I've been informed by the Company Secretary that the meeting has been convened in accordance with the Corporations Act and the company's constitution. A quorum is present, and therefore I declare the meeting open. A disclaimer is displayed before you, and it's important to understand that the information presented today is general information only and is not a securities recommendation or a statement of opinion intended to influence any person in making an investment decision. You should consider seeking independent professional advice before making any investment decision. I'm pleased to ask my fellow non-executive directors, our Managing Director and our Company Secretary to introduce themselves. Sarah, if you could go first, please.
Well, good afternoon. My name is Sarah Brennan. I was appointed to the board of ALI on the 1st of July 2024 as an independent non-executive director, and I'm also a member of the Audit and Risk Committee. Thank you.
Good afternoon. My name is Mark Hall. I was appointed to the board as an independent non-executive director in 2019, and I'm chair of the Audit and Risk Committee.
Good afternoon. My name's Fiona Hill. I was appointed to the board in 2022, and I'm also an independent non-executive director and a member of the Audit and Risk Committee.
Good afternoon, everyone. My name's Jason Berto. I'm the Managing Director and have been the Managing Director since the IPO in July 2015.
My name's Tim Binks. I'm the Company Secretary and I joined at the time of the IPO. Jason and I spent many late nights doing the IPO back in 2014-15. I'm also Company Secretary and Chief Operating Officer of Argo Investments.
Although he's not here in person, I would like to introduce Tyler Rosenlich, Portfolio Manager from Cohen & Steers, which manages Argo Infrastructure's portfolio. Cohen & Steers manages over $100 billion for a range of clients around the world and were pioneers in the development of the global listed infrastructure asset class. Given the time difference to New York, Tyler has recorded some commentary regarding the global infrastructure sector and our portfolio, which we will hear later in the meeting. I will now move on to the meeting procedures. All resolutions at this AGM will be decided by poll. As Chairman, I have called the poll. When registering your attendance, you will have received either a blue, orange or white admittance card. Shareholders or proxy holders representing shareholders were issued with a blue admission card and are entitled to vote on the poll and ask questions at the meeting. On the reverse side of your blue admission card is your voting paper and instructions. Only those shareholders with a blue card have received a voting paper. This can be marked at any time we consider the resolutions or at any other stage during the meeting. After the meeting, you can place your completed voting cards in one of the ballot boxes located by the exit doors. The results of the poll will be released by announcement to the ASX later in the day. The holders of orange cards are non-voting shareholders, such as a joint shareholder when the other joint shareholder holds the blue voting card. These card holders do not vote by poll, but are entitled to ask questions at the meeting. All visitors were issued with white cards and are not entitled to vote or ask questions at the meeting, but you are very welcome here today. I can report that the minutes of last year's annual general meeting were confirmed as a correct record at the subsequent meeting of directors. The notice of meeting has been circulated to shareholders and I propose to take it as read. I now open the polls. We will now move to the first item of business. The audited financial statements of the company and the reports of the directors and the auditor for the year ended 30 June 2025 have been published and are made available to shareholders. In the course of receiving and considering the financial reports, I now make some general comments about the year under review. This will be followed by a brief address from our Managing Director, Jason Beddow, and the Portfolio Manager's commentary from Tyler Rosenlich of Cohen & Steers. Against a backdrop of rising geopolitical risks and macroeconomic uncertainty, Argo Infrastructure grew its full-year profit to $52.2 million for the 2025 financial year. This result was driven by increased realised gains in the portfolio and the strong performance of global listed infrastructure, which provided a bastion of stability amid periods of considerable volatility. Delivering on our continuing commitment to provide steady and sustainable returns to our shareholders, full-year dividends were increased by 5.6% to 9.5 cents per share, fully franked, and another record high for Argo Infrastructure. Notably, both the interim dividend of 4 cents per share and the final dividend of 5.5 cents per share represent record high levels. Total dividends paid to our shareholders since the company was founded just over a decade ago now equals 67.25 cents per share. Furthermore, the last 15 consecutive dividends paid to shareholders have been fully franked. This underscores a significant benefit of Argo Infrastructure's listed investment company structure, namely our ability to generate franking credits for our shareholders because we pay Australian corporate tax. This is a unique advantage which differentiates us from investing in offshore assets via other managed investments such as trusts or directly. Despite considerable volatility on global markets, particularly in the second half, Argo Infrastructure's global portfolio of infrastructure stocks delivered a total return of 19.9% for the 2025 financial year. The outperformance of the portfolio relative to the broader domestic equities market was 13.8%, underscores its diversification benefits for Australian investors. Global listed infrastructure demonstrated great resilience through the significant market turbulence during the period, particularly following US President Trump's tariff announcements in early April. While broader equity markets, both locally and globally, fell precipitously in response, infrastructure stocks held up comparatively well, highlighting their defensive characteristics. Against a backdrop of heightened global trade tensions, the asset class proved particularly attractive to investors, given most infrastructure assets are highly localised businesses, not import-export dependent, that provide services essential for day-to-day functioning of the economies in which they operate. While most ASX-listed investment companies are trading at historically large share price discounts to net tangible assets per share, we are pleased that Argo Infrastructure's discount has narrowed in recent months. We believe this reflects both the strong performance and attractive attributes of the asset class, together with our track record of delivering increasingly fully franked dividends over many years. While we are encouraged by this narrowing trend, we are not resting on our laurels. We remain focused on ensuring Argo Infrastructure's share price better reflects the underlying value of the assets and continues to take a range of proactive measures, including various marketing and engagement initiatives with existing and prospective shareholders. These measures also include buying the shares required for the allocation to participants in the dividend reinvestment plan and the dividend substitution plan on market rather than issuing new shares at a discount to NTA. Furthermore, Argo Infrastructure has on-market buyback facility in place to be used when deemed appropriate. In July, we celebrated the 10th anniversary of Argo Infrastructure's listing on the Australian Securities Exchange, or the ASX. At the time, it was the largest initial public offering of an LIC on the ASX, raising $286 million and attracting approximately 9,000 shareholders. To this day, we remain the only Australian LIC providing investors with exposure to global listed infrastructure, and the only way for Australian investors to access this asset class with the added benefit of fully franked dividends. Elevated geopolitical tensions and macroeconomic challenges mean market conditions do remain uncertain. Although the extreme tariff-led volatility seems to have largely eased for now, tensions continue to simmer and could flare up seemingly at any time. With this in mind, I remind shareholders that during periods of heightened volatility and uncertainty, global infrastructure stocks are particularly attractive to investors as they tend to offer relative stability and predictable cash flows. I also remind shareholders that Argo Infrastructure's portfolio manager, Cohen & Steers, takes an active approach, operating in a large and highly liquid investment universe. This positions them to identify and rapidly capitalise on short-term opportunities created by heightened uncertainty and volatility. Longer term, we believe the outlook for global listed infrastructure remains positive, underpinned by strong structural growth drivers. These include surging energy demand to power the burgeoning data centre industry, which is supporting the AI revolution, and more broadly, the digitalisation of the global economy. Argo Infrastructure has $485 million in assets, no debt, and a global portfolio of major listed infrastructure companies, managed by one of the world's leading managers in the asset class. I would like to conclude by thanking our Managing Director, Jason Beddow, and the team for their ongoing hard work over the year. I also thank Argo Infrastructure Specialist Portfolio Manager, Cohen & Steers. Thank you to my fellow board members for their valuable contributions over the last year. On behalf of the board, I also wish to thank Mr. Russell Higgins AO, who announced his decision to retire as chairman at last year's AGM. Russell was Argo Infrastructure's chairman over his 7 years on the board, during which time the company established a track record of delivering fully franked dividends to our shareholders. Finally, I sincerely thank our loyal shareholders for their ongoing support and extend a warm welcome to any new shareholders who have joined Argo Infrastructure in the last year. I now call upon Jason Beddow to deliver his Managing Director's address.
Thank you. Yes, well, that 10 years has gone very quickly, a little too quickly. I guess when we think back, one of the primary reasons Argo Investments established Argo Infrastructure a little over a decade ago was to provide Australian investors with an opportunity to access listed infrastructure, but on the global stage. In many respects, Australia really, I guess, was at the cutting edge. We pioneered the asset class. Governments back then, were fairly insightful. They did recycle assets and they privatised, some of the long-standing but quite iconic government assets. Telstra, Sydney Airport, APA Group, Alinta Gas, the road networks on the East Coast. And so as a result, listed infrastructure companies were well liked, well understood, and for a period gave great returns to shareholders. And they were liked by investors for their reliable income, and that translated into reliable dividends. And these are essential services, so they're essential to the functioning of the economy and in any modern society. However, even back then and prior to that, opportunities to invest in these companies was steadily diminishing, as many were taken over or sold to private buyers who saw value well above what the stock market was prepared to pay for them. Now, and this trend has continued today, and really there's only a handful of infrastructure companies left in the country. So I guess the case for investing in the asset class on a global scale is probably more pertinent than ever before. It's a vast asset class. It spans emerging and developed countries. It covers many types of infrastructure. It's a very broad spectrum of investment sort of assets outside of Australia. Toll roads, tunnels, marine ports, data centres, transmission and the like. The portfolio is does have probably half in the US, but it's spread across our 18 countries, even with small holdings in India and Brazil. So the benefits of a global manager. And given it is a largely very large and very sophisticated, diverse asset class, when we sought to partner with the portfolio manager to sort of offer access to it, we looked for a specialist manager who had a truly global presence in the asset class. And Cohen & Steers really was a standout, not only for how they managed the money, but just the structure of the business. They are also a listed company. They are headquartered in New York and they're listed on the New York Stock Exchange. And they're one of the leaders in real assets, they would call themselves. So infrastructure, real estate, commodities, real assets. The firm has professionals scattered around the world in a number of offices. And we think that's important because infrastructure are local assets, local regulations, local languages, and having a local perspective on what's happening politically and with the regulatory overlay is essential, we think, to generating long-term value in that space. And we think, Cohen & Steers have delivered on that. Since inception, the manager's done a pretty good job, and we think the portfolio has delivered on or how we thought it should behave through, now we've got, 10 years of history. So Cohen & Steers have returned over 9% per annum pre-fees, but I guess that makes it equivalent to the benchmark, compared with, what you would have got as an Australian investor in the 200 accumulation index of 8.9, but with significantly less volatility. And this has been particularly valuable, and as it appears that recently the markets are just going up, but they do fall, and you really do see the defensive characteristics. So during COVID, and even more recently with President Trump began with his very punitive tariffs around Liberation Day, there's a very, very good defensive anchor to these infrastructure assets. And so they do fit nicely into the portfolio. As the chairman mentioned, we have a video from Tyler Rosenlicht from Cohen & Steers. For those of you that did attend the roadshow in May, Tyler was out here as part of that roadshow, which was great. They're talking about the asset class, the outlook, and the firm Cohen & Steers. And we have a video which we'll cut to shortly. And I guess just before we cut to the video, though, I'd like to thank the team at Argo. We are the manager of Argo Infrastructure. Also like to thank the chairman, and new chairman in particular, who stepped in, and the non-executive directors. And I look forward to working with them through this next period for you, the shareholders. And I'd like to wish you all well for the rest of the year. It's coming around pretty quickly. We thank you for your continued support. Some of you may well have been investors since IPO, and hopefully you can come along to the Investor Roadshow next year. So thank you for coming, thank you for the support, and we might cut to the video, if that's okay.
Investors' search for diversification and a focus on elevated inflation have put a spotlight on infrastructure, made brighter by massive public investment programs, accelerating power demand, and an increasingly digitized global economy. Against that backdrop, let's focus on 4 key topics on investors' minds when it comes to global listed infrastructure: tariffs, diversification of the asset class, interest rates and the macroeconomic backdrop, and our overall outlook. Regarding tariffs, we believe infrastructure companies tend to be less exposed to the negative effects of tariffs. Infrastructure assets typically have strong pricing power, which means these businesses are often able to pass higher costs on to their underlying customers. While some sectors within infrastructure are sensitive to trade and global demand, predictable revenue streams driven by long-term contracts tend to make this asset class a bit more defensive than broad equities. This has resulted in infrastructure investments tending to have lower volatility than broader equities. Further, infrastructure is benefiting from strong secular themes that we believe will keep their momentum almost regardless of tariff pressures. I'll touch on this a bit more later. Now, what about diversification? According to Preqin, portfolio diversification is the top reason institutional investors allocate to infrastructure. And we believe listed infrastructure is a strong portfolio diversifier, offering favorable downside protection while maintaining equity-like returns. All told, listed infrastructure includes about 250 investable companies globally with a nearly $7 trillion market cap. With 60% of the universe in the US, we see opportunity, not concentration risk. There are ample opportunities in Europe, Asia Pacific, and emerging markets broadly. By sector, listed infrastructure offers allocations to a diversified basket of companies, providing differentiated portfolio construction across what we have coined the CUTE subsectors. These are communications, utilities, transportation, and both traditional and alternative energy. Turning to the macroeconomic backdrop, we believe current market dynamics can provide tailwinds for infrastructure for a few reasons. One, the uncertainty premium being priced into the market is beneficial for infrastructure as an asset class, which provides more predictability in an environment of weaker economic growth and sticky inflation. Two, our macro view is that we do expect short-term yields to decline in the near term as the Federal Reserve lowers rates, reflecting expectations for looser policy ahead. But at the same time, we expect inflation break-evens to rise due to this policy easing and supply pressures. In fact, inflation continues to creep further away from the Fed's 2% target. A market in which real yields fall and inflation break-evens climb is a favorable outlook for infrastructure, and historically, infrastructure has significantly outperformed when this was the case. Finally, infrastructure assets can benefit in a lower interest rate environment due to their capital-intensive nature. Lower rates reduce capital costs, with cell towers and utilities most sensitive given their higher leverage. Regarding our outlook, we seek to maintain a generally balanced portfolio given the current turbulent market environment and the elevated level of geopolitical tension. With all the good stuff listed infrastructure has to offer, it may surprise investors to learn that the asset class is trading at a significant discount to global equities and its historical valuations. We also see three megatrends converging to unlock compelling investment opportunities: surging power demand, digital transformation, and the supply chain reinvention. So let's start with power demand and decarbonization. U.S. electricity demand is rising fast, over 3% annually through 2030, driven by AI, data centers, electric vehicles, and advanced manufacturing. Data centers alone could consume nearly 12% of total power demand by decade's end. Meanwhile, renewables are accelerating and projected to grow from 10% to as much as 50% of global generation by 2040. Second, digital transformation. The digital economy is exploding, with mobile data traffic tripling and 5G expected to carry 80% of global traffic by 2030. AI is amplifying demand across industries, prompting major infrastructure investment. And third, deglobalization and supply chains. Global supply chains are being restructured as companies nearshore production in response to these geopolitical tensions and pandemic disruptions. U.S. manufacturing construction has tripled in 3 years, boosting demand for infrastructure that moves goods: railways, ports, airports, and toll roads. These secular trends, when combined with the long-term diversification, growth potential, and return consistency provided by global listed infrastructure, make a compelling case for the asset class. Thank you for listening.
Thank you, Tyler, and thank you, Jason. Mr. Josh Hall, the signing audit partner from the company's external auditor, Ernst & Young, is present today and available to answer questions relevant to the conduct of the audit and the preparation and content of the auditor's report for the year ended 30 June 2025. Shortly, I will address any shareholder questions on the financial reports and general matters, bearing in mind that we will separately consider the remuneration report and other items on the agenda for the meeting. At which time we shall, I beg your pardon, I've just lost my way, the other items on the AGM business later in the meeting, at which time there will be opportunities to ask questions relating to those items. In addition, I will also answer any questions that we have received in advance of the meeting. To ask a question, please ensure that you have your blue or orange card and make your way to the microphone located at the front, so that all shareholders can hear your questions. Please state your name and any affiliation when invited to speak, and limit yourself to one question only in consideration of other shareholders. Are there any questions or comments about the company or its financial report at this time? Yes, Greg.
Good afternoon, Mr. Chairman. My name is Greg O'Connell and I represent 1.66 million proxy shares and 59 shareholders on behalf of the Australian Shareholders Association. I'm also an ALA shareholder myself since IPO. ASA hasn't met with the board and today we'll be just voting proxies. So first, congratulations on the 10 years of successful operation. And leading up to my question, I've got a question regarding performance reporting. And my observation is that a number of LICs report performance net of fees. We see this as a positive thing for retail shareholders who are interested in what they receive in their hands. Some other LICs leave the net performance a little opaque and report performance before fees. That makes it a little more difficult for retail shareholders to determine the in-hand performance. ALI is interesting in that its parent Argo reports performance after fees, so that's a net position, while ALA reports performance before fees. So I'm afraid I've got two questions. Could you advise what the net after fees management expense ratio is for ALI for this year, please? And the following question is, what are the chances of ALI adopting the practice of reporting performance net of fees in the future?
Jason, could I ask you to...
Yeah, look, it's a fair question. Look, I guess ALI is a little difficult in we use an external manager and they receive a fee for their work. If we want to get accurate data from them, they would give us net of fee numbers for the fee they take, not the fee that is collective plus the cost of running the company. So you end up with potentially three different numbers. We want to assess Cohen and Steers on how they run the portfolio. And so the cleanest number, because we actually receive the fees and reimburse CNS, is the pre-fee number, and that's the number we can audit on their performance and everything else. So I guess we are using that number to say, are they doing a good job? Is this a good manager of infrastructure? Because that does sit with the benchmark they're against. From that, there is 1.2%. That's clearly been since IPO, and hopefully as the LIC grows, that is less. But again, that's split. So CNS would say, well, our performance is not minus 1.2, it's only minus 0.6. And so you do end up with a bit of a complexity of which number's right. So that's why we've stuck with pre-tax, the pre-fee number, because that's how I guess we are assessing Cohen and Steers. So the fee is 1.2. If we get to $500 million, which we're close to, that drops to 1.1, and there's further tiering. And there are some 20 basis points, 25 basis points of cost to run the LIC, which you can see in, I guess, the P&L when you look at the management fees, clearly the biggest expense, but you can see the other expenses that sit under that. So, I mean, we could put out multiple numbers, but we think that's more confusing.
Thank you. I accept that was answer to part one as to why you do it, and I understand why it makes sense for Argo. Does that answer part two about what are the chances of you adopting it, a net of fees in the future?
Putting a probability on that probably is a bit hard, Greg, but I will give you our assurance that your point has been made, and we will certainly look at that through the course of next year and see if we can do something which is more consistent with the way others do it for next year.
Thank you very much.
Question in the middle, please.
It's Colin Pilcher. I'm a shareholder. This question's probably to Jason. I don't know if he can answer it, but over in Australia, companies like Goodman and Nextdoc have done very well, and I would regard them as infrastructure stocks. And they basically build data centres and then lease them out. That's basically what they do. And I understand over in America, they do things on a bigger scale over there. I can't recall the firms that are doing it. But are we invested in anything like infrastructure centres? Do you know?
Are you talking about ALI?
Yeah, I'm talking about
Look, currently, as of today, I'm not exactly sure. I mean, they have invested in NextDC previously. They would perceive that NextDC is quite expensive on a global scale, though, for data centres. And Goodman, while it does have data centres and its growth and share price is largely pegged to it, I mean, most of Goodman's earnings come from industrial real estate currently. So it's more likely that they own Goodman in a real estate portfolio than an infrastructure portfolio. But they certainly have data centres and the energy sources and transmission as part of their universe. So I've got the annual report here. I could probably have a quick look for you. But you could equally have a quick look yourself, I guess. But so I said they have owned NextDC, but not currently. Not at 30 June.
Okay.
Tony Greco, just a quick question. Jason just alluded to a moment ago that you get, 476 million worth of assets. When you get to 500 million, each extra dollar the fee is only 1.1%. Has the board given any thought to a share purchase plan, rights issue, just to get over that edge? I'll hear your point that you say, but we'd be issuing them at a discount, but have you considered it anyway? And sometimes in the good old days, there used to be share issues at a discount, which was sort of a bonus element for shareholders. Your thoughts?
If we might just hold that question, because we have a question that's come in from a shareholder who's not here that deals with a lot of the same issues. So I might address it together if that's okay. We do have a question from Mr. Neil Smith, who says, can you please try to grow the size of the LIC, of basically ALI? The board is continually considering appropriate ways to grow the company over time in order to boost the trading liquidity of ALI shares and to reduce the total expense ratio by spreading the relative fixed element of the company's costs over a larger capital base. However, at present, it is difficult for ALI to raise capital due to the share price discount to NTA, albeit that ALI's discount is actually less than most of the other LICs listed on the ASX. We have a disciplined framework for our capital management decisions based on the prevailing share price, NTA and investor sentiment. We have offered 3 share purchase plans in the company's history when shares have traded at a premium or a small discount to NTA. If the share price is trading at a large discount to NTA, such as at the current time, we purchase the shares required to satisfy the DRP and DSSP plans on market instead of issuing stock at a discount to NTA, which benefits earnings per share but does not help grow the size of the company. So I think that deals with your points. It is an active matter under discussion by the board. I think it's raised pretty much every board meeting. I've been lots of nodding of heads over there. And looking at what we can do in terms of reducing that discount and about growing the size of the company. And certainly when the opportunity presents itself, I think we'll be keen to do a look at the possibility of doing a share issue, probably through an SPP of some description.
Okay, thank you for that, Peter. Is it very expensive? Is it an expensive exercise, either the rights issue, which can then trade on the market, or
an SPP is not particularly expensive. A rights issue or anything that involves issuing a prospectus, that becomes very expensive.
Okay, thank you for that.
In terms of costs, outgoing costs that would be done. Yes.
Yeah, because I guess the other thing is, from a shareholder's point of view, and we've talked about, even in the Argo meeting, about when the share price was at a premium. So, I guess if a shareholder was to purchase at a premium, then see the discount and go, gee, this is really poor performance. So I guess from an infrastructure point of view, if you were to wait for a premium and then we went into a discount, you'd have a disgruntled shareholder. So, is it worth keeping the shareholders happy by giving them a discount, which is sort of a bonus element?
I think most share purchase plans or issues generally are always at a slight discount to the prevailing price. But when we're already trading at a discount, to offer a further discount is somewhat punishing for those shareholders who are not in a position to participate. So they may well be upset by that. But thank you for the question.
I'm back again.
You're welcome.
The question I want is similar to the gentleman before me. The share purchase, the dividend purchase plan, is that issuing new shares or is it buying shares back off market?
This year and last year we have bought existing shares off market to provide to those shareholders who are using the dividend purchase plan.
It's not diluting the shares, basically.
No. Greg.
Thank you. I'd like to take the bait and follow the issuing capital to get larger question. Based on the slide that was up earlier about ALI's premium discount to NTA, if that was indicative of the future, then it's the majority of the time it's been trading at a discount. I'd say based on that, we'll never see an SPP, assuming the past performance indicates the future. So my question really is to probably reiterate the earlier question, that is there a point looking more closely at what the level of disgruntlement is at having an SPP at a slight discount? Because if we wait for the share price to get up to par, then we might actually be waiting forever.
Greg, I think you can take it that we are actively looking at the options and consulting with not only our shareholders but people in the market to get an assessment of how appropriate we think an issue would be and the likely participation of shareholders. So there's something under, I can say, active review.
Okay, thank you.
Now move on to the next item of business. It's the Corporations Act requires all ASX-listed companies to submit a remuneration report to their shareholders for the consideration and adoption by way of a non-binding resolution. Argo Infrastructure's remuneration report is detailed within the annual report. The remuneration report is relatively short and outlines the remuneration of each non-executive director. As the company is externally managed, the managing director and other executive key management personnel are not paid by Argo Infrastructure but are remunerated by the manager, Argo Service Company Proprietary Limited, as part of their roles with Argo. The non-executive directors receive a fixed base fee, do not receive any additional fees for participating in board committees, and are not entitled to any other remuneration other than legislated superannuation entitlements. I now move that the motion that the remuneration report for the year ended 30 June 2025 be adopted. Can I ask any shareholders who wish to ask a question regarding the remuneration report specifically, please make their way to a microphone. For your information, the details of the proxy votes received on this resolution appear on the screen. Please note that this resolution is advisory only and does not bind the directors or the company. However, should 25% or more of the shareholders vote against the remuneration report for 2 years in a row, then the shareholders at the second AGM will be asked to vote on whether all directors should stand for re-election. Are there any questions relating to the remuneration report? Good. I now put the resolution to the meeting. I remind you that we are voting by poll. If applicable, please mark your blue voting card for item number 2. Thank you. We now move to the next item of business. Mr. Mark Hall retires by rotation in accordance with the company's constitution and, being eligible, offers himself for re-election today. The details of Mark's qualifications and experience are included in the notice of meeting. The other directors unanimously recommend that the shareholders vote in favour of Mark's re-election, as they consider he continues to be well qualified to act as an independent, non-executive director of the company. I now invite Mark to briefly address the meeting.
Thank you, Chairman. Good afternoon, ladies and gentlemen. It's an honour to have served you as an independent, non-executive director and chair of the Audit and Risk Committee since November 2019. I have a deep and enduring interest in infrastructure investment. My executive career involved over 25 years in senior finance positions in complex global businesses. These roles demanded deep skills in finance, commerce, taxation, governance and risk management, all of which I believe are highly relevant to effectively serving you as a director. As Group Managing Director Finance at Telstra, I was responsible for the financial oversight of an annual $4 billion capital investment program. This significant globally deployed infrastructure involved assessing, prioritising and monitoring complex capital investments, giving me a first-hand appreciation of the economics and risks associated with infrastructure investment. Furthermore, I have extensive experience in capital markets, having successfully led capital raisings both domestically and offshore. My current non-executive roles include serving as a non-executive director and Audit and Risk Committee Chair at Online Education Services, and as a member of the St Kilda Football Club's Audit and Risk Committee. Other relevant experience includes serving 4 years as a director and Audit and Risk Committee Chair for the Telstra Superannuation Scheme, which at the time managed over $16 billion in funds, including significant global infrastructure investments. I also held directorships in over 25 Telstra subsidiary companies globally, including Audit Committee Chair roles in China and in New Zealand. I've also served as CFO and interim CFO at global ASX-listed companies Catapult Sports and Redbubble Limited. In a broader context, I was a board member of the Corporate Tax Association and the Group of 100 CFOs representing the financial interests of large businesses in Australia. I hold graduate and postgraduate qualifications in commerce, accounting and taxation, and completed executive studies at Columbia University in New York. I'm also a fellow of the Australian Society of Certified Practicing Accountants. Over the past 6 years, it has been an honour to work alongside my highly experienced board colleagues and the executive team. I would like to thank the board for their support of my nomination today. I am enthusiastic about continuing to represent you in your investment, and I sincerely seek your support for my re-election to the Board of Directors. Thank you.
Thank you, Mark. I now move the motion that Mark James Henty Hall be re-elected as a director of the company. Can I ask that any shareholders who wish to ask a question regarding this resolution please make their way to the microphone. For your information, details of the proxy votes received on this resolution appear on the screen. A simple majority of greater than 50% in favour is required to pass this resolution. Are there any questions regarding Mark's re-election? I now put the resolution to the meeting. If applicable, please mark your blue voting card for item 3. Thank you. I now move to the next item of business. As item 4 of the agenda concerns my own election, I will ask Mark Hall, who is Chair of the Board Audit and Risk Committee, to chair the meeting for this item of business.
Thank you, Peter. Peter Warren was appointed to the board on 1 January 2025 as a non-independent, non-executive director and chairman following the retirement of Russell Higgins. Peter also succeeded Russell Higgins as chairman of Argo Investments Limited. Peter is a very experienced director with extensive experience and knowledge of the financial services and investment banking sectors. In accordance with the company's constitution and being eligible, Peter offers himself for election by shareholders today. The details of Peter's qualifications and experience are included in the notice of meeting. The other directors unanimously recommend that shareholders vote in favour of Peter's election, as they consider he is well qualified to be a director and chairman of the company. I now invite Peter to briefly address the meeting regarding his election.
Thank you, Mark. Ladies and gentlemen, as you would have seen in my brief resume, My executive career was in financial services, primarily financial markets, and in management. For the last 25 years, I've had a career as a professional non-executive director. Many of the companies of which I've been a director have been investment-related companies, not totally dissimilar to ALI. I believe that experience has provided me the right background to be a non-executive director of ALI. I see the role of a non-executive director of ALI as primarily protecting the interests of you, the shareholders of ALI, through providing appropriate review and challenge of corporate strategy and providing oversight of management and its actions. This includes continual review of the investment performance in line with ALI's chosen market sector and shareholder expectations, ensuring the ALI complies with its obligations under the Corporations Law and ASX listing rules, providing the appropriate information and reporting to shareholders regarding what is happening with their investment and its financial performance, seeking opportunities to promote the interests of ALI and the broader investment community, including looking for opportunities to grow and improve the liquidity of ALI, and finally, ensure expenses are maintained at an appropriate level. Many of those issues we've already discussed today. In my 9+ months on the board, I believe that it has worked to successfully achieve those aims, and with your support, I look forward to continuing to be a member of the board, working with my fellow directors and continuing to fulfil that role. Thank you, and I'll now hand you back to Mark.
Thank you, Peter. I now move that the motion that Peter Hastings-Warren be elected as a director of the company. Can I ask that any shareholders who wish to ask a question regarding this resolution, please make their way to the microphone. Okay, for your information, details of the proxy votes received on this resolution appear on the screen now. A simple majority of greater than 50% in favour is required to pass this resolution. Are there any questions regarding Peter's election? No. I now put the resolution to the meeting. If applicable, please mark your blue voting card for item number 4. Thank you. Peter will now resume as chair of the meeting.
Thank you, Mark. The poll will remain open for a short time after the meeting to allow you to submit your votes as you leave. We will announce the results of the poll to the ASX later today. If there is anybody who requires assistance with filling in the voting papers, please ask one of the representatives of Argo Infrastructure or Boardroom. As there is no other business, I declare this 10th Annual General Meeting closed. I now invite you to join us for refreshments in the foyer. Please do not forget to place your voting paper in one of the ballot boxes as you leave the room. And thank you very much for your attendance. It's been great to see you today.